Welcome back to the Yahoo Finance special, How 2020 Changed the World. I'm here with our very own Brian Cheung, who covers the Federal Reserve for us. So, Brian, as we take a look back at what we've all been through, let's start a little earlier. Let's go to December 2019. There was, at least on Wall Street, concern we might be heading into an economic slowdown, but the Fed was ahead of that well before the pandemic news, right?
Well, it was, but it's not because they knew the pandemic was happening, Adam. They were already doing what they call insurance cuts. So over the course of 2019, which feels so long ago, they did 75 basis points of total cuts. Now, if you remember, the biggest economic story at that time was the trade war that President Trump was waging on China. You'll recall that in August, that really came to a crossroads where right before the Jackson Hole speech, that yearly speech that we usually hear from the Fed chairman, President Trump had said that he was disappointed that the Federal Reserve didn't make an emergency cut in that meeting and then ended up ratcheting tariffs anyway. So there was the president who had been saying at the time that he wanted to get a lot more cuts out of the Federal Reserve. He was calling Powell a golfer who can't putt. Things were really looking quite ugly at the time. But again, as we did head into 2020, the original question before we knew that there was a pandemic was going to be whether or not the Federal Reserve would continue to extend that if the trade war did end up getting worse. We got that phase one trade deal, which seemed to take some of that tension off the table, but that was the prevailing question before, obviously, we got that pandemic.
And so let's go to that period, say March, when lockdowns were now taking place in the United States. How did the Fed immediately respond? What did they do?
Well, the initial response was an emergency 50 basis point cut. You'll recall that happened 30 minutes after the opening bell in the first week of March. And that was a really interesting situation where the Federal Reserve had started to acknowledge that this was a risk. Now, up until February, it was already on many policymakers' radar that, hey, it's a possibility that this COVID situation, which was really flaring up in China at the time, could come stateside. Now, if that was to be the case, the Federal Reserve officials said that they could adjust their policy stance, which they ultimately ended up doing with that first initial 50 basis point cut. Shortly after that, you'll recall that on March 15th, on an emergency announcement on a Sunday night, the Federal Reserve slashed interest rates to zero as the cases in the United States were really starting to flare up. First on the northwest coast in the state of Washington, you'll recall that the Federal Reserve then apparently looked at that and said, this is a situation that is getting financial markets in a bit of a tizzy. A lot happened in those first few weeks of March, as was the case for everyone, as everyone started to go inside their homes and realize the gravity of the situation. But the Federal Reserve was also doing their part to try to make sure the economy didn't lock up as well.
Let's talk about those liquidity facilities, because some of us who are old enough to remember the first time we went through this alphabet of different kind of lending facilities back during the Great Recession. Here we go again. What specifically did they do, and did they work? Because now, I mean, today's headlines are they're pulling back on the facilities and the deals with Treasury to provide the seed money for facilities. Well, that's going to end at the end of the year.
So the Federal Reserve needed to decide, how are we going to target our response here? And the Federal Reserve responded in the middle to late March with this idea that they were going to open up basically bazookas on everything imaginable. So they reopened some old facilities that you recall were existent during the 2008 crisis, like the commercial paper funding facility to try to offer short-term loans under 90 days to corporates, in addition to that term asset-backed lending facility. But then they also opened up a number of new facilities that we had never seen before, things like the primary and secondary market corporate credit facilities, where they would say, we can commit to buying corporate bonds and holding on to them in exchange for loans to these companies. They had not done that. So companies like Ford, companies like Apple were able to sell some bonds to the Federal Reserve. Now, the Federal Reserve actually did that in the secondary market, so they were actively going out there and purchasing it. And then there was also things like the Main Street lending facility, where the Federal Reserve was saying, we're going to try to extend credit to small to medium-sized businesses, in addition to the municipal liquidity facility, where they would be offering loans to state and local governments as well. All of these were new. Now, the uptake of all of them was fairly low. And whether or not you say that's a success or a failure depends on what side of the coin you are. You could argue, well, it's a low uptake because it means that those facilities were allowing private players to offer better rates. Or you could say that the uptake meant that the Fed was putting too high of a penalty on borrowing from these facilities. So a bit of a mixed bag, and I think history ultimately will tell in the future whether or not this response was appropriate.